Welcome, everyone, to Be the Boss of Your Money. We're just getting started. We are on camera number 3. This is my switcher. You see my hand, camera 1, camera 2. Now we're camera 2. But I like to start with camera 1. But welcome to Be the Boss of Your Money. This is a show about personal finance, which includes so many aspects of your life, from investing, the psychology of money, your financial goals, how to choose financial goals that are worthwhile, figuring out how long you have to reach those goals, and then working backwards to devise a plan so you can figure out all of the little steps along the way that you need to take to reach your financial goals. It's about credit scores, borrowing, mortgages. We talk about everything financial on Be the Boss of Your Money, the name of this live stream, so that you could take control of your money, not your money taking control of you. That's why we call it Be the Boss of Your Money. Be the boss. Record highs today. Wow. It seems like the record highs came suddenly and swiftly. And after the 2 or 3 previous weeks, it seemed like we wouldn't be hitting record highs for a while, right? It was feeling pretty gloomy. Interest rates were rising. Stocks were down. Inflation was going to be too hot. None of that. We are back to feeling good, back to the bull market. So let's just roll a quick intro. We're going to get into this. We're going to look at which stocks led the Dow year to date to its high. We're going to talk about the major sectors, how they all did. We're going to talk about some of the losers on the Dow and what I think comes next for a couple of them and for you. And we'll talk about how this impacts your life, your personal economy. So here we go. Stick around. It's going to be good. Hey there, welcome to Be the Boss of Your Money. Holy cow, we have another huge rally going on. It started a couple of days ago. From Monday, we started down. We finished with a pretty good opening, with a pretty good end of the day. Tuesday was good. Wednesday was good. I think yesterday the big thing was how well the NASDAQ held up. Yesterday, just about flat on the day after a near 4% rally the day before, and everything rallies today. We're back to the bull market. As a matter of fact, we never left the bull market. We just had a spate of volatility. Now, I want to just say a couple of things, some housekeeping. If you're watching this in the live stream, welcome. If you have any questions, you know what to do. Ask in the comments. I would love to answer them. It's my favorite part of doing this. Also, if you're watching in the replay, welcome to you as well. Any questions that you may have, hit me up in the comments. For anyone watching live streaming or replay, words of wisdom, words of encouragement, stories that you want to share, that's all welcome here. So hit me up in the comments. I would love to hear from you. That is always the best part of Be the Boss of Your Money. And that's how I know what to talk about. Look, I've been doing this for 31 years now. Whoa, over 3 decades. I can't believe it. It's like when I say that, I'm like, am I that old? It's crazy. So over 3 decades, I've learned a lot. I've made mistakes myself. I've seen the mistakes of others. I learned from it, done a lot of things right, corrected a lot of things. A lot of clients come to me with portfolios and financial plans filled with mistakes, and then I have to fix them. And we take time to fix them. It's a great thing. It's a great thing to look a client in the eye and see how satisfied and happy they are after you fix everything and get everything back on track. It doesn't mean the client's on track to meet their goals. Sometimes people are just not going to meet every goal. And sometimes people exceed their goals and everything in between. But we have to work with what we have, maximize what we have. So let's get into it. If you have any questions, again, words of wisdom, comments, hit me up in the comments. Let's take a look at how the market did today. Bada bing, I'm up here in the left-hand corner. Bada bing, bada bang, bada boom. Andrew Dice Clay, right? And here we are, the Dow up another 188 points, record high. Nasdaq up 2.5%. S&P touches a record. We're almost 4,000 on the S&P. I mean, it's incredible how far this part of the world, the stock ownership part of the world, has come. Not everybody's participating in this, but if you would like to participate in the stock market and do it right, watch my show. But there's a ton of content out there, though. Seriously, there's a ton of content, so much educational material today. You have no excuse to mess it up. Now, if you're trading, getting aggressive on Robinhood, just so you know, about 90% of day traders lose money. And with men, there's a 20% chance of becoming a gambleaholic. Okay. So you better watch yourself if you're trading on Robinhood. You better really watch yourself and what you're doing. And if you need to walk away, walk away. Robinhood is trading, not investing. It's about the gamification of stocks. You buy a stock and it says, hey, you want to buy some options? And people are like, oh, yeah, I'd love to do that. Like they have no idea what the heck they're talking about. So just a little word to the wise, because, if you're watching this, there's a good chance that I'm a little older than you, so maybe I could tell you this. Okay. We've got a comment out there. Let's see. What is your opinion about a state government creating its own cryptocurrency? Well, Rick, first of all, thank you so much for being a subscriber to my YouTube channel. First of all, state government creating crypto. I think state governments, federal, state. I'm thinking you're talking about nation state governments. I think they have to create a crypto. I mean, if you think about how electronic moving money is, for example, when the Federal Reserve does quantitative easing and buys $120 billion of bonds and puts money into the economy, what they're doing is they're putting electronic credits. They're not actually printing cash. They're creating electronic credits, which is like crypto. It's electronic. Okay. But I think governments have to do that. I think the dollar is not far from being just a digital currency. We use the dollars mostly as digital as it is anyway. I mean, we're all walking around paying for things on this. We're not touching the money. We're paying our bills through this. We're credit card bills. We pay through this, everything, like cars, everything. So I think they have to. And I think if governments want to retain some control over their currency, they have to do it. And that's a very big thing to help stabilize and, the economy, things like that. So we're moving in that direction. I don't think it's Bitcoin, if that's what you're asking. I definitely don't think it's Bitcoin. That's not the government's purview. I think the government wants to have its own digital currency, and the best bet for the U.S. government is to just make the dollar as digital as possible. I mean, if you could combine the wiring of money, which is like digital, you wire money from your bank account to someone else's bank account, okay? Or you Venmo somebody from your bank account to someone else's bank account. It's pretty much instantaneous. And what if you combine that with like DocuSign? So you have like a digital contract in a way. That's what like blockchain is all about. That's what Ethereum is about, smart contracts. So I think you could actually get that to work if you could put together like a DocuSign and Venmo or something. I'm just thinking out loud. I'm just, it takes a little bit of creativity and imagination to put this stuff together, but that's my opinion. So let's move on. Let's take a look here. Thank you for asking, by the way. Folks, you have a question out there, hit me up. I'd love to hear from you. Okay, so we have the Dow up 188, NASDAQ, S&P up, gold up a touch, oil continuing its strong run this year, 10-year treasury kind of flat. Remember I said 1.6 is the line. We see 1.6 or above. People start to get shaky in stocks. Below 1.6, they're all comfortable with stocks. I think the market will adjust to higher rates, providing that the economy justifies it. But right now, I think we're in Goldilocks. VIX down to 21.91. Do you know what I mean by Goldilocks? What I mean by the Goldilocks is that we have an economy right now that's not running too fast, too hot, not too cold. It's kind of just right to leave rates steady and gives the stock market an opportunity to just focus on earnings and growth, which have been really good and getting better. And this whole economy that we expected to accelerate, we expected the U.S. economy to accelerate pretty hard in the second half of 2021. It's starting to happen a lot sooner than we expected. That's why you're seeing gasoline go up. Okay. That it's just more usage. People are driving more. People are going to work more. People are, state restrictions like Texas, they're being lifted and people are getting out. This is not what I want to show you. The Boeing up to 252. That's a stock we've been talking about since 200. Wabash over 20. Wow. That is big. That is a good move for them, but that's not what I want to show you. I want to get to sector ETFs. Just take a look at the major sectors of the day. Technology, you could tell the leader, the NASDAQ, was up a lot today. Communications up, consumer discretionary up. Everything up over 1%. Real estate up, commercial real estate, XLV, the healthcare sector. These are the big sectors, the ETFs that track each of the 11 sectors of the S&P 500. Okay. XLI, industrials up. Staples, utilities, and financials are off a little bit. Look, financials have had one hell of a run so far this year. So to be off a little bit and take a little profit, I don't think is that doesn't concern me in the least. Okay. So let me stop sharing the screen, go back to here. So let's get into the heart of the matter. I want to talk to you about what led the Dow up. Okay. I have all of my notes. You could see it better in screen 2. Okay. Screen 2. You see that? I don't ever have to worry about anybody cheating off of my work or copying my work because no one could read my handwriting but my wife and I. My wife could read my handwriting. Took a long time to get to that point. And, we're married over almost 30 years. So, but my handwriting really, really sucks. So let's go. There are 7 stocks year to date in the Dow Jones Industrial Average that are up 20% or more. That's a pretty stunning number considering the first quarter is not even over. I feel like we're doing like a year-end review for the quarter, but we're doing it, near the middle of March. But the record is so stunning because last week, the week before, things were so negative and the rally was over and people were blowing out of positions and selling out of their stocks. Lesson learned. Holy cow, we have to talk about the lesson learned. This is why I always say, I don't believe at all. I don't believe in all in or all out investment strategies. I'm all in stocks. I'm all out of stocks, and you're just shifting everything. You might be able to, you might be able to shift before a down market. You might be able to buy before an up market, but the odds of you doing both are so low, and then doing it again are so low that, in my opinion, it's not even worth trying. Not worth it. Jay, I see you out there. I'm going to take a look at your comments in 1 second. Okay. I'm already laughing at your comments, but so, this is why we say, we've been talking about the stay-at-home work-from-home stock, explaining why the stock market was surging even during a pandemic and the economy was falling apart, a year ago. We came out of March. So a year ago, we're still going down, but let's say 11 months ago. And then I'm talking about where the market's going up because the largest stocks benefit a lot from the current environment, from the stay-at-home work from home. And they're the biggest companies. So they have the biggest impact on the S&P 500. Let me take a breath here. And then we have a handoff, a rotation into economically sensitive reopening stocks like industrials, financials, energy, consumer discretion, that sort of thing. And the handoff is going very well, but we're actually seeing a lift in all markets. Like even yesterday, the S&P was up, but what was down were the FANG plus M stocks: Facebook, Amazon, Apple, Netflix, Google, and Microsoft. And the market still held on just fine. That is a huge sign of broadening out of the rally. It's that is a very bullish sign. Okay, that's super, super bullish. Jay is out there. You write like a doctor. I know. I can tell. Thank you. And but I'm sure lots of good stuff in there. There is a lot of good stuff in there. So thank you very much. Thank you for getting me back on track. 7 stocks up over 20%. American Express up 21.67%. Caterpillar up 20.5%. Goldman Sachs up 30%. Intel up 26%. JP Morgan up 21%. Walgreens, WBA Walgreens Boots Alliance up 28.9%. But the winner, Chevron up 31.42% year to date. Home run. And again, it's only we're not even done with the first quarter. And the Dow year to date is up a little over 6%. S&P is up almost 5%. NASDAQ is up almost 4%. The Russell 2000, that's the small cap index we always talk about. Russell 2000 is a small cap index. Small caps are more sensitive to the domestic economy because they get more of their revenues domestically, while larger companies can get more of their revenues from international markets. But the Russell 2000 up a little over 18% year to date. And bonds, the only loser in here, BND, that's the big Vanguard bond fund. BND, Boy Nancy David, down almost 3.5% year to date. So not only are you getting like near no interest, but now you're losing money on it also. This is why it doesn't pay to have all of your money in bonds, because you need a mix. Even a portfolio that is 90% bonds and 10% stocks is more conservative, meaning less volatile, than a portfolio that's 100% bonds. That's right, because a mix of stocks and bonds actually helps mitigate the volatility. It's also known as diversification, which is a strategy that we use to minimize risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. I said that pretty good, right? I'm going to give myself a round of applause. Thank you. Sit down, everybody. Sit down. It's okay. Okay. So, the last 2 weeks turned out it was one gigantic opportunity knocking at your door. Okay. And here we are back to record highs. So what were the winning sectors so far that has brought us this far this year? Financials up 16%. That's the second place finisher. Building materials, the material sector up 8.5%. But energy is up 41% this year. Remember last year, people tossed their energy stocks in the garbage? Not this guy. I can't actually say exactly which energy stock I'm bulled up on that is in my clients' accounts, but you can call me privately, DM me, whatever. I'll tell you. Okay. I don't want to just give you all the stocks here. I have to teach you how to think for yourself. So here's the lesson learned from the whole shebang over the last 2 weeks. It goes for me, but I never get overly excited when the market goes down. And I never get overly excited over ebullient when the market goes up. I'm pretty even keeled. Listen, to do this as long as I have, you have to really be able to take the volatility and not let it affect you. And it really doesn't. Whether if the market is up, 3 or 4% in a day or down 3 or 4% in a day, it doesn't actually change the way I live my life. It doesn't change my night sleep. And it's because, I have myself and my clients set up with the appropriate portfolios based on our own individual life cycles coming up, risk tolerance, time horizon, that sort of thing. And that's what this is all about. So don't just have the work from home, stay at home stocks or just the reopening stocks and just rotate from one to the other. You could overweight one or the other, depending on your preferences, your view of the risk and the reward. And that's about it. I'm so glad you're out here. If you have any questions, ask me. We're going to be ending in a moment. Rick, you have another one out here. Which top 5 lower cost stocks that regularly pay dividends do you recommend? There are a number of stocks that I'm looking at that pay dividends, that I look at daily, that pay dividends. It's a funny thing, Rick, because it's a whole thing for me to recommend individual stocks into the show because of licensing and regulatory issues. But I have a handful of stocks that have actually stopped paying dividends because of the pandemic that I actually think are going to reinstate their dividends in a small way, and then they become dividend growers. I actually made a video about that, but among the names that I made in that video were Southwest Airlines and GM. There are a number of big dividend paying stocks that you've heard of, so I'll name some that you have heard of, but there is still Chevron, there's AT&T, there's ConAgra, and overall, these are pretty mundane names. I don't go into any of these stocks because you think they're going to be fast growers. And I just want to let you know, all of you, I'm not making recommendations with the Dow 30 stocks. I really want to be clear on this, that I want to teach you, educate you, and look at what's working and why the Dow is going up to new highs. I could also tell you that Merck is down 9% on the year. Procter & Gamble is down 8.5% of the year on the year. And there are a couple of other losers. Salesforce.com is down. Johnson & Johnson is only up 1%. With all the news about the Johnson & Johnson vaccine, you basically made all the money in Johnson & Johnson in 2020. And this year, it's just kind of riding its new higher level. Okay. So, Jay, what do you think? Do I like mortgage REITs? It depends what kind of REIT. There's a lot of different kinds of mortgage REITs. So are you talking about suburban office, urban office buildings? Are you talking about the REITs that have a lot of cloud computing in them? What's the name of the big one? The REIT with it was Procordia? I forget the name of it. It slips mine at the moment. But there's a REIT that has a lot of cloud computing. It's all about leasing space for servers. So it really depends. There's mortgage REITs, which is just basically how you see interest rates. So there's a lot of REITs that you have to look from. And I think that REITs in general, as part of a diversified portfolio, I like. For an asset allocation model, for example, of exchange traded funds, I think REITs could be a part of it. So that's what I think. I don't think it's something that is going to be the big winner in your portfolio, but I think it just gives you some diversification, and REITs do pay a lot of dividends. My question is, how will the my concern is, how will the post-pandemic world look for REITs that are leveraged? Because we don't know how many people are going to go back to the office. We don't know how companies are going to attempt to reduce their footprint. Hope that helps. Dividend paying that paid high yields have to stop, and with the reopening may reinstate. Look, there's a lot of companies and REITs that have stopped paying the dividends, and we expect them to start reinstating small and then grow the dividends. And then you have dividend growers, which is like a whole special, class of stocks, dividend appreciation. But we'll have to see. A lot of companies might just pay a dividend because they feel they have to do it, just so nobody gives up on the stock. Some of them will be able to afford to raise it. There's been a hell of a shakeout. We just don't know what it's going to look like, And Rick is asking, do you manage for clients a Roth or individual? I do both. Or sort of like Edward Jones and mutual funds. Two things. I prefer not to use mutual funds. I just prefer exchange traded funds. If I had to use them, I would, but this is kind of the way I roll. I just feel I can be more efficient that way. The other thing is, yes, I manage lots of Roth IRAs, traditional IRAs, and I also do help clients with Roth conversions. So I think that's par for the course. So, financial advisors do that. I think the more important thing with between Roth and traditional IRAs and health savings accounts and that sort of thing is for investors, for clients to know where, know about the best locations, the most appropriate locations for their money, because you've got tax deferred money, you've got tax free money, and then you've got both. For example, like a health savings account, you get a tax break on it, a tax deduction on it. Plus, you could take the money out tax free for healthcare expenses, which we will have. And then you've got a traditional IRA that could also be funded from a 401k rollover. So I think it's important to know about the location of your assets. And I think that's a more important discussion than just saying, Roth, or I'm not trying to insult you. I'm just trying to say as opposed to just discussing, I do a Roth or I do a traditional IRA, I help people with that. I think you just have to know the benefits and location, and maybe some people are better off maximizing their 401k plan until they get the company match. And after that, stop putting money into a 401k, for example, and put the rest of the money into a traditional or Roth IRA. So these are things that I think come into play. And I think these are really impactful activities for a client's future potential financial well-being. Okay. Hope I answered that sufficiently. All right. Coming up to the time here. Thank you so much for watching. Jay, it was great speaking with you yesterday. I really enjoyed the conversation. I can't believe how many parallels our wives have, unbelievable. And I'll be back Monday. All right. Every Friday send out a blast email. That's my content for Fridays. If you want in on the email list, hit me with a DM and I'll put, with your email address, and I'll put you on it. And that's about it. Thank you so much. See you on Monday. So happy early weekend. Bye.